Private equity funds are designed to generate enhanced returns by pooling investors' capital and investing in private companies. They create value through driving business growth, streamlining operations, and supporting acquisitions. Investors provide private equity fund managers with the capital needed to invest in companies often identified through thematic research and deep professional networks. Private equity managers actively seek to work with the management teams of these companies with the goal of eventually selling shares at a profit and distributing those profits to investors. Private equity managers are typically focused on creating value in the underlying companies in their portfolio from the time they invest in a company to the time they sell the company. And there are many ways that value can be achieved, including organic growth and inorganic growth. Organic growth initiatives may involve expanding a company's geographic footprint, developing new products or service lines, cross-selling products to existing customers, and increasing spend on marketing. Private equity managers may also augment or upgrade a company's existing leadership, such as bringing in a new CFO or adding a senior head of sales. Inorganic growth initiatives involve acquiring complementary businesses or smaller competitors to create a stronger market-leading firm. Inorganic growth includes operational improvements, which involve increasing margins by streamlining costs, with the goal of improving a company's bottom line. Now that we've covered some examples of how private equity managers create value, let's review the investment strategies they leverage. Each private equity strategy focuses on a specific stage in a company's life cycle. The primary private equity strategies are venture capital, growth equity, and buyout. Venture capital funds invest primarily in startups within innovative sectors, including technology and biotech. The company profile can range from early-stage companies to later-stage companies. Early-stage companies often do not have revenues or positive cash flow and have limited historical financials. Later-stage companies are typically past the revenue and business model validation phase, but need capital to scale and improve profit margins. Venture capital is the riskiest private equity strategy, but also the one with the greatest return potential. Growth equity funds invest in companies that are profitable or close to profitable, but still maturing with proven business models, established client bases, and strong revenue growth. Minority or majority investments are usually made in a growth industry or sector. Growth equity investments are typically less risky than venture and therefore have a relatively lower but still very attractive return potential. Buyout funds invest in established and mature companies, typically using debt and equity financing to acquire a controlling interest or significant influence. Buyouts can span investments in small, mid-sized, or large companies, ranging from $50 million to $1 billion or more in revenues. In a leveraged buyout, a portion of the money, typically 40 to 60%, is borrowed to cover the expense of the acquisition. Buyout investments are the least risky of the three private equity strategies and therefore have the lowest but still relatively attractive return potential. Another entry point into private equity is secondary funds, also known as secondaries. The private equity secondaries market typically refers to the transfer of private equity fund interests from an original buyer to a buyer or entity who assumes all ownership and all obligations associated with the acquired interests. Secondary buyers purchase existing commitments from limited partners or investors who are seeking to exit their investments in mature private equity funds before the end of the full fund term. Traditional private equity secondary investments typically provide investors with diversified exposure to underlying investments in various strategies, including venture capital, growth equity, and buyout. Private equity funds are considered long-term investments with terms of 7 to 10 years or longer. Investors are expected to remain invested for that entire period, and therefore withdrawals or redemptions are either limited or not permitted during the full term of the fund. It's important to note that the alternative investment industry continues to evolve, and that includes the introduction of an open-ended fund structure, which does not have a finite lifespan and provides additional liquidity features. In an open-ended fund, capital is fully funded upfront and not in stages over time. When comparing private equity to other investment opportunities, there are three things that stand out. The first is the potential for enhanced returns. Private equity has historically generated long-term outperformance over the global public markets. And that is the case across numerous time periods, including 10, 15, and 20 years. The second is the consistency in returns coupled with downside protection. Private equity has historically delivered strong returns across multiple cycles, providing downside protection during notable market downturns. And the third is the impact of adding private equity to a portfolio. In addition to absolute returns, private equity has also generated strong risk-adjusted returns. Allocating a portion of an investor's assets to private equity offers the potential for reduced portfolio volatility. As an example, we took a sample of portfolios with a traditional 60-40 stock bond allocation over the past 20 years and added an allocation to private equity, funded from stocks. By investing 20% of the portfolio in private equity, the annualized performance increased and the portfolio volatility was reduced. Before investing in private equity funds, it is also important to understand the key risk considerations. We'll go through 6 of those risk considerations now. 1. Manager selection. Not all private equity managers are the same. Managers' experience, skill level, and track records vary greatly, and as a result, the dispersion or difference in returns is much greater than in other asset classes. It is critical to have a thorough diligence process in place to evaluate private equity fund managers. 2. Liquidity. Private equity funds are considered longer-term investments, with terms of 7 to 10 years or longer. 3. Transparency. Private equity funds may not offer the same level of transparency as traditional investments, which are required to provide full and frequent disclosures. 4. Fees. Private equity fund managers charge an annual management fee of typically 1 to 2% of assets under management. Fund managers also collect performance fees, known as carried interest, which traditionally represent 10 to 20% of any value appreciation or aggregated profits generated by the fund. 5. Leverage. Private equity funds may use some form of leverage, which offers the potential for higher returns, but also increases the downside risk. 6. Concentration. Private equity funds may be highly concentrated in a few underlying portfolio companies. This video provided a brief overview of private equity funds and their potential role in a diversified portfolio. Please contact iCapital, a fund manager, or your wealth management platform to learn more.